Now, UBA's full-year 2017 earnings results showed growth in top and bottom line items. Revenue was up 20.31% to 461.5 billion naira, and profit after tax rose by 8.75% to 78.5 billion naira. Ugo Nwaghodoh, the Group Chief Financial Officer at UBA, joins us now to give the facts behind the numbers. Thank you so much for joining us on the show today, Ugo.
Thank you, Amy.
Of course, notwithstanding the slow economic recovery we actually experienced in Nigeria in 2017, just taking a look at this report here, you see you actually had recorded an unprecedented, profit of about, 105 billion naira by the end of 2017. What I want to understand is what really drove these numbers. What did you do differently in 2017?
Okay, thanks, Onyi, for having me. There are a couple of factors responsible for the 105 billion PBT that we reported. But I'll just highlight a few. The first thing really is that we had very strong growth in interest income. This was some 23% growth, and that's a total of about 62 billion in absolute terms. And the reason for this is largely as a result of improving balance sheet efficiency and balance sheet management, as well, of course, as the higher yields that we saw in a number of our markets. The high yields characterized the market in Nigeria for like the first 3 quarters of 2017, as well as high yields that we also saw in Ghana, which is one of our largest markets. The other factor is also the fact that we were able to manage cost of funds. Weighted average cost of funds stood at 3.7%, and this is quite tight, given the tight liquidity we saw in the markets in 2017, particularly at the second half of 2017. So all of that put together enabled us to achieve some 26% growth in net interest income.
We're talking about, of course, reductions that you've mentioned. We actually see that your operating expense did grow by 23% to begin with. Talk us through what really played out behind this, and what's the strategy going forward to push that number down in 2018?
Well, if you look at the trend of corporate earnings that has been reported in recent times, particularly from Nigeria, you'll see that the impact of the devaluation in 2017, 2016, and the impact in 2017 has continued to linger on. So the lag effect of that and the resultant cost push inflation arising from all of this has resulted in increasing the cost of doing business across the country. But what I would say is that we are very, very committed to operating efficiency, and we'll continue to work to improve our cost optimization processes and objectives to ensure that we achieve a reduction in the cost-to-income ratio, which we target to get to about 50% in the medium term.
Just to take you back to what you mentioned earlier, around the space, they're talking about yield. There are those who say if you take out what the banks made in terms of what they incurred from the T-bill space last year, really the banks really had nothing else to offer. If you take out that in terms of the profits you made within that particular space, what else is the bank putting on the table? Where else did the money come from? Did you widen your base in terms of your customer base and deposits? What played out?
Oh, clearly there's so much more than just interest income. Like I did talk about interest income when I spoke earlier. We also recorded about 14% growth in non-interest income, and this arises from so many factors. One of them is the fact that we're having improving FX liquidity in the market, and that helps you to improve on your FX trading income, your FX margins, as well as even overall trade-related incomes. Also, the improving transactional revenues also coming from increasing customer base, increasing offerings that we're rendering to customers, and we're seeing significant migration of customers from the normal brick-and-mortar banking style into digital platforms, and all of these increase transactional incomes for the banks. So there's a lot more than just interest income in banking, in the banking revenue streams.
It's also interesting to note that your subsidiaries contributed over 40% of the profit we actually see this year. I want to understand, your strategy around your foreign operations and how sustainable you think this particular number will be in 2018. Do you see them doing more in 2018?
Oh, yes, certainly they will do a lot more.
Okay.
If you know the history of our foray into Africa and also into the global space, you'll find that just some 10 years back, UBA overall contribution by these subsidiaries was less than 5%. today, we're talking about more than 40%. And this is, well, even despite the fact that the overall group revenues is growing aggressively. The growth you are seeing today is as a result of operational efficiencies and more so as a result of growth in market share. They continue to consolidate their position in each of these markets, and they continue to grow their market share. And what that basically does is that all the incremental revenues basically are coming to us as little or no cost. So the direct impact of that is straight on the profit performance. So in 2018, we will expect even much more from these subsidiaries as many of them are beginning to grow market share and growing towards becoming systemically important in their various markets.
Just a further breakdown from the numbers I'm seeing here, there's actually a surge in your non-performing loan as well, almost kind of like doubled. I mean, from 6.7, we actually see that 6.7% at the moment at the end of 2017 from 3.7%. What was responsible for the spike?
Well, what I would say is that the overall credit quality in UBA remains very strong. The spike that we witnessed in 2017 was largely attributable to the classification of a particular large customer loan, which quite an unfortunate incident, but it's happened and we've had to do the responsible thing. We've classified the facility and we've taken a very prudent provisioning against this particular facility. If you isolate that particular corporate loan, the NPL ratio will have just been 4.5% and the cost of risk will have just been about 1%. So going forward, we continue to work to resolve this particular facility, and we hope that in the course of this year it will be resolved amongst some others, and then we will be able to moderate the NPL ratio back to desirable levels.
Interesting. Now, talking about what might play out in 2018, give us your outlook for 2018. Also bear in mind the downward trend in interest rates. What is your outlook for 2018 for UBA?
Well, 2018 for us holds a lot more brighter prospects than what we saw in 2017. And we talked about our operations out of Nigeria. Those will continue to work stronger and contribute even more into the group's profits. As you know, UBA is not just about Nigeria. So if we have lower yields in Nigeria, we would have that will be ameliorated by our operations across other jurisdictions. If you look at even in Nigeria, in the course of this 2017, the Nigerian business grew profits by about 20%, which is remarkable. Although that was masked by the huge circa 15 billion provision that we took on a particular facility. But despite that, we believe that both Nigeria as well as the operations out of Nigeria would contribute significantly into the group profit for the year ending 2018.
Thank you so much for your contribution, Ugo Nwaghodoh there, the Group Chief Financial Officer at UBA.